Welcome back to Morning Markets on Tuesday, the 2nd of November. Turning first to markets of yesterday, a strong day for equities yesterday supported by robust earnings from the US and evidence that whilst prices are rising, demand remains firm, and this is assessed using the Purchasing Managers Index and forward guidance. Japanese markets were encouraged by the result of the election, paving way for Prime Minister Kishida to push ahead with stimulus plans. Looking at the markets themselves, the equities in sterling terms, here in the UK, FTSE 100 was up 0.7%. In the US, the S&P 500 was up around 0.2%, the Nasdaq up 0.6%, Europe up 0.7%, and in Asia outside of Japan was relatively flat, but that to a degree was pulled down by China, which was off around 0.3%. Japan, as I mentioned there, up 2.6%, so a strong day for Japan overall. In terms of bond markets, UK 10-year gilt yields were at 1.06%, so up 2.7 basis points. And US 10-year Treasury yields were at 1.56%, so up around 0.4 basis points. In terms of currency markets, the dollar was slightly weaker on the day. It was down around 0.25% against a basket of international currencies. Sterling against the dollar was at 137, sterling against the euro 118. And in commodities, Brent crude was at $84.4 per barrel, so up nearly 1% there on the day, and gold was up around 0.5%. So turning first to just a few different areas there, you've got earnings, and so far around 60% of the largest 500 firms in the US have reported their Q3 final results. And of these, 82% of those firms have reported actual earnings per share higher than analysts were expecting. At present, the running rate for the quarter is earnings beat, so earnings ahead of expectations, around 10.3%, which is above the 5-year average, which is 8.5%. The positive earnings surprises are led by healthcare, communication services, information technology, and the energy sectors. Though price pressures are widely discussed in the forward guidance of the companies, there is evidence of strong demand for goods and services. A similar theme, therefore, runs through the Purchasing Managers Index readings released yesterday. We had results from China, from Asia, Japan, the US, and Europe. Of the reports, so far it's evident that data across the manufacturing and services sectors in the main remain expansive, so above the base level of 50, which we often refer to. The UK and Japan see an improvement in both sectors on a month-on-month basis. The key theme across the PMI readings being demand remains strong, so strong that manufacturers are still challenged to meet this with supply, given delays in supply chains, shortages of basic materials, and also challenges attracting workers to the marketplace. Overnight, we also received an update from the Reserve Bank of Australia. The decision was taken to maintain interest rates at the current level of 0.1%, where it's been for 12 consecutive months, and will continue to maintain the rate at which they purchase government bonds under the quantitative easing programme at a rate of 4 billion Australian dollars each week until at least mid-February 2022. There was an important area of development in the announcement. The RBA agreed to step back from their intervention in shorter date government bond yields. At present, they have a yield curve control mechanism, so they target a yield of 0.1% on 3-year government bonds, so out till around April 2024 at this point. This was a mechanism which was put in place to support liquidity during the pressures of 2020. The announcement follows reports last week which demonstrated inflation has moved into the central bank target range of 2 to 3%. At this level of inflation, the RBA are not concerned, but with central forecasts anticipating inflation to start to move up, but peaking and elevating back towards a 2.5% level at the 2023 end of year, and only for moderate wage growth to come through. They are very aware, but at this stage remain comfortable. The decision taken really maintains loose financial conditions, encouraging economic growth, so working not to choke off economic growth there, but demonstrates that the central banks are active in responding to signs of inflation, but current conditions do not warrant interest rate hikes at this stage. As discussed yesterday, we've got several central bank meetings this week, including the meeting of the Federal Reserve in the US on Wednesday and the Bank of England's Monetary Policy Committee on Thursday, which we'll continue to bring you up to date on. Thank you very much for watching today. We look forward to bringing you up to date tomorrow here on Morning Markets.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.